Good morning, and here we're going to talk about the summary of economic projections, and this was released by the FOMC, basically the Fed over in the United States, and this really just outlines their full plan for the next, I guess it's like 3 years, and it's not great. There is a chance that we won't have a recession, but let's start and see what happened with crypto. Okay, let's jump into this. A little bit of a deep dive. As you can see here, the crypto market hasn't really been affected. We've seen what, 0.5% drop, 2.5 for Ethereum. So obviously, one thing I will note as a side, kind of a side track here, we are seeing that Bitcoin is becoming more of this digital gold. It's holding its value much, much better than the likes of other cryptos, which are being slightly more volatile at the moment, as you can see here. Now, I won't go into too much detail. Obviously, we're here to talk about the summary of economic projections. We see the Hang Seng down by 1.5, Nasdaq down by almost 0.8, and then obviously another indice in the US is the SP 500, down by over 0.5%, and over in the UK, because we're not really affected by it, less than 0.1% of a downturn. So overall, the market didn't react very well. Now, why didn't it react very well? Well, it's kind of weird in some ways because we had a 50 basis point hike. Now, this is moving us from a 75 basis point hike. I believe we had 3 in a row. So 3 consecutive 75 basis points hike. That brought us up to a level of 4%. And as you can see, I'm saying us, but I mean the Fed. This brings us up to a 4.5% interest rate, okay? So this is essentially the rate at which it costs for banks to borrow money from each other and also from the federal bank. And I've done a video on this previously, and if you want to watch it, head down into the channel, but I'm not going to go through exactly how money creation works right now. It's very long. Now, what's anticipated herein afterwards, this was actually said by Jerome Powell in his speech after the summary of economic projections was released, is he said, look, we are still a way off. There is still work to do, but he said that he was very proud of everything they've done so far. So what pretty much all economists are now anticipating is that we're going to have a 25 basis point hike from here onwards. Now, the question is, where does this stop? Now, this is where me and this website, investing.com, have a very different opinion. But I'll tell you why I think I'm right. And I definitely do think I am right. But I'm going not with economists on investing.com. I'm going with the Fed themselves, the guys who make the decisions. So stay tuned. Stay tuned. Right. So there is a 7.4% chance, just to explain this, a 7.4% chance that we will actually have a decrease in the Fed fund rate. Okay. And so that's sitting here. As you can see, we're currently at 4.5. Well, okay. This is where it might get a little confusing. This is the upper limit. Okay. 4.5 is the upper limit. And so currently we're at 4.5. So they display this number even though it's the upper limit. So my mistake, it's not a decrease, it's actually just staying the same in this same region, okay? Now, there's a 92.6% chance that we're going to see a 25 basis point hike up from the upper limit of 4.5 to the upper limit of 4.75, because it's always a range. It's never just one number. So this is where we're at. And then we're going to see another 25 basis point up to that 5 handle up at 90%. And then this is where we have a discrepancy. I believe we're going to have a Fed fund rate of around 5.1, which means we have to increase by another 25 basis points up to the maximum Fed fund rate of 5.25. This is where I am going to be putting my money. I'm going to be betting on this here. Whether that actually really means something, in the long term, I don't know. We have 3 more CPI reports. We've got one in January, one in February, and then one in March. So that's really going to determine when, what happens to, and a couple more actually by the time we get to May. So my opinion could change, but I'm going on what I've seen in terms of the data. The only thing I want to warn you away from, guys, is people, this is actually not correct. The one thing I wanted to mention about the Moon Carl, he said he was going to sell his Bugatti if Bitcoin didn't hit. If you remember that, leave a comment down below because I'm very curious I can't find the tweet. I've tried to go through, but he did say it was like, "Oh, I'm going to sell my Bugatti if Bitcoin doesn't get to a certain price by the end of the year." And I don't think we're going to get there. Honestly, I don't think we're going to get there. The thing I did want to mention was the FOMC is tapering off interest rate hikes. This is true. We went from a 75 to a 50. We're likely to go to a 25 again. Incredibly bullish for Bitcoin. This is why I have a lot of concerns about when people say this, because I think the way to get clicks in crypto is to just be bullish no matter what. Now, I've been quite notorious for being, hey guys, let's be realistic here. The economy's going down the toilet. So I've been getting hate for the past 3 months, 4 months. But where's Bitcoin gone and come from? We're at the lowest levels we've seen in months. And I've been right. And also on Satoshi Society, we've seen AJ getting getting 8 trades out of 9 correct. So the evidence is there. And again, thanks for nuking us all. To be fair, he is trading on a 1 minute time frame, or apparently. So he's saying don't trade on the 1 minute time frame. Yeah, looks bullish to me. A lot of people are kind of like, hey, hang on, chill out a second. And then someone comes in, central bank projections for target Fed fund rate rises to 5.1 in 2023. This guy knows his stuff. Alessandro, you know your stuff. Equals 1 more year of a bear market. And that's what I think people don't look out for. They see Fed fund rate drop, the big headline, oh, it's bullish, this is going to get me clicks. And I don't like that. I do respect the guy. He's a fantastic content creator. That Martini guy, great. But this is just an overall peeve that I have, and then again we get headlines like this. Bitcoin, Ethereum dropped sharply after Fed signals more interest rate hikes to come. Kind of speaks for itself, really, doesn't it? Kind of speaks for itself. And that's not on the 1 minute time frame, by the way, guys. That's the daily. Yes, it was quite a big drop, but anyway. So we want to talk about this, the summary of economic projections. This was released. I'm going to actually change because I can't annotate this for some reason. So let me just go on to here. Let me go. Well, first I have to find it, don't I? Summary of economic projections. Allow. No. What a moron. What an absolute idiot. Isn't it? I know you guys are like, hang on a sec, hurry up. What are you doing? Okay, summary of economic projections. This one. So I've got to edge in order to be able to, just so you know, same thing. Summary of economic projections for release on 2 p.m. on Eastern Seaboard time, which was yesterday. So anyway, this is what we're looking at. First things first, we're going to talk about the change in real GDP. Just to let you know, guys, I'm moving out of the camera, whatever. In fact, I can just move my computer. It's the beauty of having this separate. I love it. Otherwise, you'd be looking at my mad double chins right now. I mean, you probably still are, but it's all right. Anyway, change in real GDP. This is kind of what the new summary of economic projections is now. And then, obviously, this is what we were anticipating previously. Okay, so September projections. And this is why it's good to see these be reviewed every 3 months. I think it's every 100 days, it's around then. But anyway, every 3 months, we come up with a new projection. And so this is going to tell us over the past few months, the most recent bits of data, how has that influenced the Fed's opinion on how they need to act? So the most important thing is GDP is looking to be revised down. So we were anticipating a growth of 0.2% back in September, okay, as you see here. And now we're looking, okay, by the end of 2022, we're looking at a 0.5% growth. So we've upped the growth for this year, but we've massively decreased the growth for next year. So we kind of anticipated, hey, there's not going to be a recession. And now everyone's talking about recession. Now everyone is worried. Now everyone's like, right, okay, we actually might be pretty screwed here. So next year is not looking great. So that's why we're looking long term. We're not very happy about this new number of 0.5 here. Back in 2020, moving forward to 2024, 2025, we're looking pretty good. So I think we're going to be back to normal. Everything, the whole COVID worries, the whole money printing, which then led to inflation, which then led to, where we are now, I think we'll be okay. And we can look, these are just the median, okay? The median, and we all know what median is. We have a look at the range, we have the range. So the median is 0.5, but the range is actually 0.2 to 0.5. And then the central tendencies pretty much are like, look, guys, most of us are pretty much shouting out that we're going to be around these numbers here. So that's how it works. And then you got a straight line all the way along here. So then you got GDP up here, you got unemployment here, and you can see how it's laid out. I know it looks mad confusing, and you're like, what the heck do all these numbers mean? And you can also download this. You can just type in summary of economic projections, get it straight from the Fed website, download it, and you're away. So unemployment rates, we want to see the unemployment rate move up to 4.6. And I know this sounds terrible, right? I don't want to see the unemployment personally move to 4.6. But we are looking towards an unemployment rate up to 4.6 and above our provision of 4.4. Okay. So this is showing that the jobs rate is still too high. What we have at the moment is in a really good economy, okay, there are typically lots of people that have jobs, right? Everyone has a job. So there's not too many other jobs that you can move into. What's happened recently is that because there's so much money, okay, that got printed during COVID to help businesses grow, this money then led to expansion of companies. It then led to extra hiring. And then we had an issue, okay, and this is called the wage price spiral. I'm just going to do this quickly. Okay, so money comes in. So then the business, so company A, they have loads of money. And then they start hiring. So then they hire with this extra money, okay? But then company B, he also has loads of money, okay? And then someone who is like, let's say, unemployed, they then get a job. And so they're earning like $1, they're earning one money. But then this guy's also hiring and he says, oh, you've got experience from company A. That's quite good. Why don't you come down here and I'll give you $2? So then what happens is and then you have company C and then they're hiring, they give $3. But because everyone is hiring and they're giving their customer or they're giving their employees more and more money, you then end up with a scenario where every company has to charge more in order to pay the higher salaries that they have for their staff. Now, when they do this, you end up with a wage price spiral. That's the word for it. That's what everybody talks about on Wall Street. And this is really, really bad for the economy because people have to keep raising rates, and then people have to keep raising the rates that they pay their employee, but they also have to raise the price of the product they sell. So then people who don't have a job, they end up getting screwed because they're not getting the higher salaries that than the people who are being hired because they don't have a job, but they are still having to pay the higher prices that every company is now putting their products at in order to pay for the higher salaries. And this is considered extremely bad. I'll get rid of all of this, but you can see how a wage price spiral really gets out of hand and is terrible. So what needs to happen is we need to have a ratio. So at the moment, well, previously there was a 2-to-1. So that for every one person, there was 2 jobs. Okay, which obviously means that in order for this one person, he can choose any job he wants. He's got 2 different jobs to choose from, and this is just the ratio. This amount of jobs, this amount of people. So it's really, really competitive. Like these will have to charge a lot more just to poach that one guy, and that's a wage price spiral. We're now down to around about a ratio of 1.7, so we are seeing less jobs per person, which is a move in the right direction. Ideally, we want it to be like 1-to-1, so that then if someone says, look, you haven't got too many other job options to go to, so you might as well join my company, even though I'm paying you a lesser salary. Weird way to look at it, but that is one of the key elements behind this whole story, in and around all finance, all central banks, and everything. So it goes on in every country across the world. But anyway, this is why we need to see unemployment creep up. We want higher unemployment so that we get rid of this wage price spiral, and then the companies who are then making stuff, can charge less for the stuff they make because they pay their employees less because they haven't had to poach a new one at a crazy high rate. So that's one thing that's really important. So we are seeing, look, 4.6, a revision to the upside, and that's going to be, I hopefully we get there. If we do, that should bring inflation down massively for the rest of us, even though, unfortunately there are going to be people unemployed. And so, yeah, this again, the only thing that's worrying about this though is this rate. Keep doing that here. So sorry, this range. So the range, yes, the median is 4.4 and 4.6, but the range is 3.7 to 5, and now it's up to 5.3. Now that is concerning because we have to look at a scenario where these ranges, the ones on the outliers, if these come true, then we could end up with a lot of people, massively unemployed, and that's not a good scenario. Or equally, we could end up with only 4% being unemployed, which again is not a good, because we're still going to have inflation, we're still going to have the Fed squashing the stock market, trying to hit companies really where it matters. PCE, this is just basically inflation. So we have core PCE and we have normal PCE. Normal PCE, it's not exactly the same thing, but it's pretty much, you can liken it to CPI, and this is Consumer Price Index, and this is core. This is core CPI. So that's core inflation, and that's CPI-linked inflation. Consumer Price Index. This basically just includes food and energy. That doesn't look great, I know. Sue me. So this includes food and energy. Core doesn't, because food and energy are extremely volatile. Russia invaded Ukraine, and then we end up with a case where food, obviously, together they produce 12% of the world's calories. So obviously, if they can't ship stuff, food is going to go up. Energy, the amount of energy that is exported from Russia, primarily into Europe, is crazy. Okay, so obviously prices go up, availability goes down, etc. So we are seeing this really not become an issue as much anymore. And Jerome Powell did mention this specifically. He said it's not going to be, he actually said it's going to continue to be a concern. But previously he said, look, it's starting to be a concern. So we didn't know where it was going to go. Now we feel like we are seeing energy prices come down. We're seeing food prices come down. So I think this PCE will be relatively good. And I think this will begin, we'll begin to have the PCE fall in line with the core PCE. Now, if we have a look, some kind of good news, I guess, kind of good news. In 2023, we're looking at having core PCE down to around 3.5, which is actually really encouraging. And the thing is, this is also weirdly higher than this 3.1 that we get on the PCE, which includes food and energy. Now, why is that? It's because in order to include food and energy, we have to change the weighting of this. Okay, so there's basically a basket of goods. In core PCE, around 30% of this whole index, right, that makes up PCE goes to housing. Okay. Yeah, you know what I'm talking about. You can't read what I'm talking about, but you know what I'm talking about, okay? And so I genuinely think once we begin to see housing come down, because at the moment housing is just so expensive, it has been crazy expensive. As rates are increasing, less people are buying. Yes, we still have orders coming through, but to sell a house or buy a house, it takes about 4 to 6 months anyway. So, this is where we are still seeing those effects. Now, as the interest rates are increasing, people are buying less. And as people buy less, if you really need to sell your home, you sell it cheaper, you sell it faster. Okay. But if you don't need to, then the housing market starts to take a massive dip. House prices come down, rent comes down. And that's what's going to affect this. I think because real estate and everything, it's a lagging indicator. Okay. We don't just, like food, the price comes down, the next month we see it. Okay. With real estate, the price comes down and we don't see it for another, like 4 months, 5 months, 6 months. So we are going to begin to see a massive effect here. And I think this is probably the only catalyst that could allow the Fed to pivot really quickly. Okay, and I think this could happen potentially in maybe Q2, just after Q1. I don't think it's going to be great in 2023, but I think in Q2 we are going to see a really, really big drop from the Fed, and I think they might even start reducing rates quite quickly, even though they have said that their Fed fund rate will be continuing on. And just to mention this here, we can see here, so projected approximate policy path, okay, and this is where we're going to get to. This is the Fed fund rate, as you see here. So we're looking at a 5.1. This is why I disagreed with everything that we saw before. I'm not gonna bring us back, not yet anyway. But as we saw, it was, what was it? A 7% chance of just staying at 4.5. Well, if we're looking, right, okay, if we're looking, and we know we were over here, but we're looking at a range, okay, a range of 5.1 to 5.4. And bear in mind, they also predicted a range of 4.1 to 4.4, and now they're like, okay, we're going to end up at 4.4. So they went to the high side. And now they're, in September, they were projecting this, but they've always got this wrong. They've never got this right. And so this is why I'm more inclined to be like, look, if the Fed fund think that they need to end around a 5.1 to a 5.4, I'm going to put my money, we're probably ending on a 5, maybe a 5, a 5 to 5.25, which will give us this 5.1. So this is why I genuinely believe that we are going to be ending up around here for a Fed fund rate. And I think, it could be that we get up to a 5 relatively quickly, and then we just stay there for the rest of the year and then start coming down. But I'm a firm believer that the Fed really do now genuinely believe that we are going to be getting to these higher rates. And then even, when people say, "Oh, let's be bullish," like bullish, we're at 4.5 at the moment. The range, the minimum of the range is 4.9. Look at that, for 2023. So how can you say that we're not going to increase it? This is not a necessarily very bullish scenario. We shouldn't all just be buying into assets right now. I think this is crazy. But anyway, that's my kind of take on that. Looking at real GDP, I'm not going to go through actually most of this because, as you can see, it's very boring. One thing that is important, though, this is called the dot plot. Doesn't say it on here, so I'm going to write it because you need to get familiar with this. Dot plot. Writing is terrible once again. Anyway, this basically says, here we go, okay. So there's a certain amount of people, right? Every single one of these dots is a person. And they will say, okay, well, look, in the long run, I think we're going to be at this level. Gosh, I'm going to put my little dot on 2.5. Someone goes, no, that's crazy. We're going to be at 3.5. So they put their little dot up here. And then everyone will go through, at 2022, where do you think we're going to be? Well, they all thought 4.4. Every single one thought they were going to be at 4.4 because, as you see, 4.4, right? So it makes sense. So when we get these ranges and stuff like this 4.9 to the 5.6, let's just have a look. This is where we get the 4.9 to the 5.6, where we're looking at stuff down here. So 4.9 here, as you can see, to the 5.6 here, as you can see. So this is where we get these ranges. Now, most people are kind of anticipating us to be on the lower, hence why the median is down at 5.1. And so just looking at how we're going to be going over time, we do have this kind of strong trend line moving pretty much to the downside like that. That was the worst thing I've ever drawn. But we can see this kind of, moving generally down in a trend line. So we will have inflation back between that 2-3%. I would say probably by 2025, maybe the tail end. But we are definitely looking at moving in the right direction. So yeah, we can see overall, most people very much agreeing on that 5.1 when we get into 2023. So then we're, again, we're looking at going from 5.1 as a Fed fund rate, start reducing this, really bringing this down. What's crazy, though, is we have some people who are down at 3. So they're like, what are these guys saying? I can kind of see a bit of the story. Like if you want it to be at 3, they might think, hey, we're over tightening. Because also bear in mind, they're doing quantitative tightening. I'm not going to get into that, but the government are basically selling $90 billion worth of assets they bought up during the COVID pandemic. Yeah, they're selling $90 billion a month. So they are essentially, that will bring inflation down, and so that will reduce the need to have the Fed fund rate so high. But we're quite polarized in that some people still think we're going to be at a Fed fund rate of 5.6 or 5.7 when we get to 2023. Sorry, no, 2024, which is quite crazy. And then he's probably the same lunatic. I don't know if it is, but I don't know. Maybe this guy's a genius. I don't know. But there's we're seeing even when everyone else is like, oh yeah, no, we'll probably be back to normal. Maybe by like 3, maybe 3.5, maybe 2.5. Yeah, there's still someone who's like, okay, we're going to be up here, which is crazy to see. It's crazy to see. Luckily, in the long term, no one thinks we're going to be above around 3.25. But overall, this is kind of what we're seeing. This is the dot plot. Just going to continue moving down here. There's not really too much that we need to talk about. So we're talking about real GDP, looking at the different projections. This is just a graphical projection of, or I should say, realization of what we saw previously. There's a couple little notes in here and stuff like this, but unemployment rate, yeah, having a look through this. Yeah, you can just see a general chart, but it's a diffusion index, so not entirely relevant. But yeah, that is basically the summary of economic projections through here. I've just wanted to go through, analyze that a little bit for you. Hopefully it makes sense. I know I've just been chatting for an awfully long time here. Let me just bring this up again here. Right, so we've done that. Okay. It looks quite nice, like neat and tidy, doesn't it? I do want to, let me just connect here. US bond, okay, the US bonds jumped on the news of the Fed, okay, because they basically said, look, we're going to be essentially quite hawkish. We're going to be raising rates for longer, and the market doesn't seem to agree, okay? And that's because the yields have jumped up on like a 10-year. So the market doesn't necessarily agree. I think the market feels a little bit more optimistic than the Fed is, but the Fed kind of have to do that. Now, I've mentioned what we have coming up. 2 CPI reports. What do we have? Yeah, we have 2 CPI reports. No, one in January, one CPI in January, one in Feb, one in March. And then we have on January 7th, we have a labor report. Again, as you see, Jan 12th CPI. And then late Jan, we have Q4 earnings. Now, this is just as Meet Kevin here has said, earnings likely to create huge uncertainty or fear. And this is going to be in like the general stock market. People want to see a Christmas rally. It's known in the industry as a Christmas rally. So these things do exist. But I don't feel good about the next couple of months. And also, we have been dealing even Q4 earnings. Okay, I know during Q4 the DXY has gone down, but relative to other currencies, it was still quite high. And so yeah, at the moment, I think international sales will be down for big American companies, which I think is another issue. But also, inflation was at its highest during Q4, and so I think with that as well, it's going to be very tough for certain companies to be reporting, very strong earnings, which is not good, but alas, is the way that the world works. And also the labor report coming out early Jan will be quite interesting. Again, it's another jobs report. So anyway, that's me. I didn't want to carry on for as long as I have, but look at me. I've been half an hour on it now. That is everything that you need to know about the FOMC, about the summary of economic projections, what we're looking for next year, and how you should be potentially playing the next 3 months because of what the Fed have said. Let me know if you liked the video. If you did, obviously, smash the like button, subscribe to the channel, and I will see you in the next one.